Hi, and welcome to Indemnity Periods. Make sure time is on your side. This is part 3, and we'll be taking you through a discussion of various claims examples drawn from the claim settlement company issues and claims that we've been through. My name is Andrew Holdcroft, and I'll be with you for the next few minutes to take you through. Thanks very much. Let's get started. Remember, this presentation generalizes business interruption principles. Always seek specific advice for each situation. In this part 3, we're going to be talking about multiple events, cessation of business, seasonality, additional costs, damage versus interruption, and catch-up. First of all, multiple events. I had a printing client who was based in Christchurch, and they suffered during the 2010, 11 and 12 earthquakes. The first event was on the 4th of September 2010. They suffered minor damage, and their normal resumed 2 weeks later on the 18th of September 2010. Let's jump forward to 22nd of February 2011. They suffered major damage to their 10-colour Heidelberg printing press. The replacement machine was installed in July 2012, but they had more presses, and so they were able to continue partially operating. They continued to earn turnover despite suffering a very significant loss of turnover from the 22nd of February onwards. We jump forward to June 11. They suffered further major damage to the remaining 3 printing presses. The replacement machines again were ordered and installed in the same month in July 2012. Again, they were able to continue partially operating through a number of means. Through hiring machines and outsourcing work, they were able to maintain some level of turnover. We then jump forward to December 2011. Again, the earthquake was quite major, but no further damage occurred to their business assets. Effectively, what happened was the machines were reset and the partial operations continued. In terms of indemnity periods and multiple events, each event effectively triggers a new indemnity period, and each new indemnity period is going to continue for the duration of time that the damage causes a loss of turnover. And so our first event of the 4th of September 2010 caused some damage, which caused a reduction in turnover. The reduction in turnover as a result of the damage continued for 2 weeks. And so our indemnity period from the 4th of September 2010 is 2 weeks. That's fairly straightforward. We jump forward to February 11. Major damage. A new indemnity period commences on the 22nd of February 2011. The maximum indemnity period for this business was 12 months. The machines were replaced in July 2012, some 17 months later, and so the losses for the indemnity period beginning in February 11 were limited to 12 months. So the ongoing losses from February 12 onwards are not covered, despite a new event occurring on the 13th of June 2011. On the 13th of June 2011, we have another new indemnity period commencing, and the reduction in turnover claimed is based on the loss of turnover due to the damage to the machines that occurred in June 2011. Now, these machines were also replaced in July 2012, and so for a significant period, we have a full cover from June 11 until February 2012. But then from February 2012 onwards, we do have uninsured losses. And from June 2012, all our losses are uninsured because the maximum indemnity period has been exceeded. The event in December 2011 caused minor damage. Again, a new indemnity period starts on the 23rd of December 2011, but the indemnity period for that event continues for only 1 week. because the damage that occurred in December 2011 was very minor. All that was required was for the machines to be reset. Now, this did take 1 week, but effectively, after a week, the damage that occurred on the 23rd of December had been repaired. And so the indemnity period that commenced on the 23rd of December 2011 expires on the 30th of December 2011. So multiple events do create new indemnity periods at each event, but the indemnity period must be tied back and continues only for as long as we can clearly see that there is a loss of turnover resulting from the damage that occurred on that date. Cessation of business is another complicated one. It often causes a lot of confusion because some policies do specifically have a cessation of business clause wording in them. And with any policy wording, you need to read the specific clause that's in your specific policy to make sure that we get the right interpretation. I will use a case study to demonstrate what happened in one of our claims. It was a successful cafe located in Otaki, an hour north of Wellington, and the cafe was destroyed by fire. The cafe had a business interruption policy with a 12-month maximum indemnity period. The building wasn't reinstated. The cafe owner attempted to locate alternative premises, but none were available, and so the cafe did not reopen. Insurers paid the full 12-month loss. This is what the loss calculation looked like in summary form. We started with 12 months of standard turnover. They were turning over $500,000 per annum. Their maintained turnover was zero because they didn't resume operations, so they achieved no turnover during the indemnity period. So our 12 months reduction in turnover is $500,000. The rate of gross profit is 60%, and so our 12 months loss of gross profit is $300,000. There were no increased costs of working, but there were significant savings. Because the business did not reopen, it was able to achieve significant savings in a lot of its fixed costs. It saved a lot of money on its payroll and other fixed costs that would normally be ongoing. It was able to achieve significant savings to the tune of $190,000. And so the loss of gross profit is offset by these savings, resulting in a claim of $110,000, plus claim preparation costs, which were $7,000. The key point to note in regards to cessation of business and indemnity periods is that where the business ceases, the indemnity period payable will depend on the reason that the business did not resume operations. This story would have ended very differently if the cafe was in financial difficulties and was about to close its doors anyway. And what also needs to be noted is that the insured has an obligation to mitigate losses. So in our case, the cafe reduced many of its fixed costs in order to achieve significant savings. Seasonality can also impact indemnity periods. If we take an example where we've got a fire on the 1st of January 2016, a 12-month indemnity period will end on the 1st of January 2017. Our business is very seasonal. It's a resort in Northland. It achieves its peak turnover in January at about $700,000. This turnover drops steadily over until winter, where it bottoms out at $400,000 per month, before starting to rise again into the summer months, achieving $700,000 in January, as expected. If we have a fire on the 1st of January 2016, the 12-month indemnity period will end on the 1st of January 2017. If the business doesn't resume its operations and get its turnover back to normal within that 12-month period, then any losses ongoing in month 13 and onwards will be uninsured. And what seasonality means is that it can cause a significantly large loss in just a few months. And so if the indemnity period is slightly insufficient, then a seasonal business will be adversely impacted by these losses in the few months after the end of the indemnity period. What's the difference between a date of damage and a date of interruption? Well, it comes down to the definitions in the policy wording. The definition of the indemnity period normally states the period beginning on the date of the damage, but policy wordings do vary. For example, they might say the period during which the results of the business are affected, or that cover starts with the interruption following loss or damage. The key here is that in this last wording that we've got, where it says that cover starts with the interruption, well, the interruption may not be on the same date as the date of the damage. So if the interruption is delayed for some period after the date of the damage, then the indemnity period will not start on the date of the damage. The additional increased costs of working clause will normally say something like, you are insured for necessary and reasonable expenses, provided they are incurred during the indemnity period. Some wordings did not contain the proviso that the cost must be incurred during the indemnity period. I was asked that, well, perhaps there is no indemnity period applicable to additional costs. My advice was that we should do everything we can to get the business back to normal operations to avoid having to go through this issue. And that's what the result was. Catch-up is where a loss of turnover during a disruption is caught up once production resumes. I'll use a case study, an example of mine. An ice cream manufacturer suffered a 3-month disruption. Some of her customers, which were ice cream parlours and supermarkets, ran down their stock levels during the 3-month disruption. When production resumed in month 4, these customers ordered more than normal stock to replenish their own stock levels. So if we have a look at this manufacturer's expected turnover, we can see that it's quite seasonal. We can see that their peak level of turnover is $700,000 in January, dropping during the winter months and then steadily rising again into the summer months. During our disruption, which lasted for 3 months during January, February and March, we can see that the actual turnover achieved was less than expected. In January, for example, we achieved $600,000 compared to the expected level of $700,000. So we've suffered a loss of turnover of $100,000 in January. A similar loss of turnover of $100,000 occurs in February and in March, and so our loss of turnover over the 3 months is $300,000 until we resume normal production in April. But the story doesn't end there. In April, customers replenished their stocks, and so ice cream sales for our manufacturer achieved were actually $600,000 compared to the expected level of $500,000. So what we would say is that in April, there was a catch-up of $100,000 in turnover. In May, our turnover has resumed to normal at $450,000. So our net loss of turnover is a $300,000 losses in January, February and March, less the $100,000 catch-up in April, to give us a net loss of turnover of $200,000. But the story doesn't end there. In our situation, if turnover had continued at normal from May onwards, the story would have ended. But in our situation, that did not happen. The facts of the story are that a key customer cancelled their contract with our ice cream manufacturer during the 3-month disruption, and there was a permanent loss of turnover from then onwards. So despite the April turnover of $600,000 catching up some of the loss, and the May turnover returning to $450,000 to make it look like turnover had returned to normal, the ongoing loss occurred in June, July and August because of this permanent loss of a customer. This customer was eventually replaced in September, And so in September, our actual turnover achieved of $400,000 was the same as expected. And so our indemnity period has continued on until September. The indemnity period continues until turnover has returned to normal. Thanks for watching these 3 parts. Just a brief summary as to what we've covered today. In part 1, the key takeaway is that the indemnity period is the length of time for which benefits are payable under the business interruption insurance policy, and it starts on the date of the damage. To calculate the indemnity period required, we need to understand the business, identify the insured risks, and ask the mill what they would do to recover and how long that would take, including regaining customers until turnover returns to normal levels. And in part 3, I chose a number of claim examples to demonstrate that each loss situation needs to be assessed on the facts of that particular loss. Thanks for your interest in watching part 3 of the Claim Settlement Company's presentation on indemnity periods. You should recommend to your clients that they appoint us to assist them with preparing their business interruption claim, because the insured must prove their claim and we act for them, because insurers will appoint a loss adjuster whose role is to check the claim, and we have 15 years experience in helping people prepare and settle their business interruption claims. Ring me or email me now at andrew@claimsettlement.co.nz if you've got any queries on this presentation or any claims or pre-loss issues that you'd like to discuss with me. We want your feedback. What was good? What could have been better? And what topic would you like to see next? We really do value your feedback, so please do email me with your comments and thoughts. Thanks for your time. See you next time.